going to introduce our first speaker, who's Tom Dolby from MHBS. As you can see his picture there, and that's going to become relevant in a second. You need to just grab this that was sent an email to you, which is the MHBS Mortgage Solutions leaflet. So just make a grab for that. Tom has been Specialist Lending Manager at Harborough Building Society since joining them in 2019. He's based in the East Midlands and works there and across East Anglia to help find solutions to complex cases and support them packaging their cases ready for an application. He gained a degree in sociology in 2012 and began his career in the mortgage sector and completed his CMAP in 2019. He's recently married to Catriona, a primary school phase leader, and both of them are motorbike mad, enjoy regular trips to the south of France, but obviously not at the moment, I would imagine, because he would be on constant quarantine. So Tom's interesting fact, and there's a reason for that picture being there. Now I'd like to look at that picture and look at the picture in the smaller box, please. Tom was once in a very dimly lit restaurant in London having dinner when he heard someone say quietly, "Oh my God, that's Liam Hemsworth" behind him. Tom was apparently in much better shape then. We'll take your word for it, Tom. Next thing you knew, someone was asking him for a selfie. He still feels guilty, but also laughs when he thinks back to the look of embarrassment when they realised he is unfortunately not Liam Hemsworth, who I had no idea who he was, by the way. They still took a selfie, though. No doubt deleted it shortly afterwards. I can't see actually any resemblance whatsoever, but maybe that's a new photograph of Liam and an old, that's not, well, new Tom and old Liam, who knows. Okay, so I just need to click on Tom's presentation. I'll disappear for 20 minutes. And Tom, over to you.
Thanks, Tony. Can everybody hear me all right? Tony, can you hear me?
So I can hear you perfectly. I'm just turning my mic off now. So yeah, hear you perfectly.
Yeah,
can you can't hear Tom, just put in the message.
Lovely. Right. Hi, everyone. Yeah, thank you, Tony. I'm Tom Dolby. I'm Specialist Lending Manager from Harborough Building Society. Like Tony says, I'm based in East Anglia and East Midlands. I love being able to support brokers facing complex cases. It's great to have everyone here today, and thank you for taking the time out of your days to come and listen. I'm hoping you're going to find sort of the next 20 minutes sort of interesting and useful. So in this short session, I'm going to explain a bit more about how MHBS work with you to find the right solutions for your clients, especially those with kind of unusual circumstances or multiple complex factors. I'm going to talk about our personal, flexible approach, which has been endorsed by our 5-star FIFA rating. And we're going to focus on a few key lending areas that you can see there on screen. So expats, holiday lets, high net worth, unusual properties, and bridging. I would like to start just first by introducing my team. We haven't got the slide up there at the moment, but they are based in all areas of the country. All their details are on our website. Hopefully they might have been sent to you as well, all their contact details. They are providing hands-on support for your case queries and new applications, and they're available at the end of the phone or email. So what can you expect from Harborough Building Society? Well, we specialise in finding the right solution for your clients, whether it's a straightforward case, has unusual circumstances, or has multiple complexities. We can lend up to £3 million on properties in England and Wales. We have over 2,500 product types, meaning we can match our products to each of your clients' individual scenarios, and we treat each case individually to ensure that our solution really does meet their needs. We never rely on automated decisions or credit scores or anything like that, and we don't have any restrictions on things like max loan to income or debt to income ratios. All these factors mean that they allow us a lot more flexibility when we are reviewing your cases. You will have a dedicated point of contact for every case inquiry that you do submit. Our underwriters are also available on the phone, just like the specialist lending managers. They are happy to answer any queries that you might have, and they will ensure that you're updated at every stage of the process and that you have all the information that you do need for your client's cases. All your cases will be individually assessed, and they will be reviewed by our executive team at our daily credit committee meeting. So what this means is that you can expect a fast and a reliable decision on every case that you do give us. So what do we specialise in? Well, we've got a vast experience in a variety of lending areas. I would like to give you a brief overview of our key key lending areas. Obviously, the 5 that I've already mentioned, we will come back to and cover in more detail. But in addition to those areas, we have a flexible approach to both buy-to-let, holiday-let, you name it, really. All cases are assessed on full affordability. We have no ICR requirement, and that does obviously include buy-to-let and background properties. And there is no upper age limit on buy-to-let or holiday-let. In terms of income, we underwrite manually. So again, the flexible approach means we can accept much more complex income scenarios, ranging from anything from foreign sources to trusts, investment pots, and to even more challenging self-employed scenarios. And we are also happy to consider clients who don't necessarily pay UK tax. We also provide many solutions for older borrowers, especially where they have potentially non-standard pension income or they require interest-only facilities. We can help clients with a requirement for joint borrower sole owner, and we can take up to 4 applicants on the case. And there is absolutely no need for those applicants to be related. And we can also consider joint borrower sole owner for buy-to-let as well. We are understanding of real life situations, and we really do want to understand your client's circumstances. And we accept various reasons for capital raising. So if they want to gift funds to family or even friends, they want to buy a second home or put towards the purchase of a buy-to-let, they want to pay off their debts, or even if they want to invest in a share portfolio or suitable capital raising for business purposes, we will consider it. Hopefully this does give you a bit of a feel for the areas that we can consider and that we have got a lot of experience in. So if you do have an unusual case and you're not quite possibly sure how to proceed with it, do please give us a call. I think Tony showed it a few moments ago, but I have got what we call our mortgage solutions handout, which I can send to you, or I think you can download from our website or the Specialist Hub website as well if you want it. Just before I go further, I just want to run quickly through our process, just to give you a bit of an idea how all the cases work. Obviously, it starts off with a decision in principle. Your case is reviewed by a credit committee. We meet every morning at 9:30, and they will give you a fast, reliable decision. In the response, you will receive the ESIS as well as the application form and a list of requirements. Obviously, then on to application. So once we've got that from you and the key documents from you, we'll pass it to our mortgage processing team and our underwriting team, who will obviously start picking up and assessing the case. Obviously, offer, the bit we all want really. Once it's been reviewed and we've got an acceptable valuation, then we will offer the issue to you, and then obviously completion. For yourselves as brokers, we will pay the prop fee within 5 working days. So what do our intermediary partners say about us? I think our feedback really does speak for itself. We take pride in the way we approach your cases and your clients, and we're really proud of the service that we are delivering. I think one of the examples here is fitting. You know, the service and willingness to help was impeccable. You know, our team really are here to just help you. They specialise in the challenging cases, and they're always looking for ways to actually make a case work. You know, excellent service in a very flexible and difficult time. You know, obviously lockdown was difficult for all of us. You know, it was challenging for you guys as well as us. From our point of view, we very quickly adapted to finding different ways to keep business ticking over and supporting brokers. You know, our daily credit committee with our chief exec, it still continues over Zoom every morning. And, you know, we have found new ways of doing things, such as using AVMs where we possibly can. So now I am going to move on to our 5 key lending areas, and we are going to start with expats. So this is an area we have specialised in for many years. We offer both residential and let options for expat clients, as well as consent to let as well. We can consider the majority of countries and currencies, and we can even consider multiple currencies on one application. We have no stipulation that at least one applicant needs to live in the UK. We will stress test between 20 and 30%, depending on the currency the applicants are paid in. This is just to account for potential future fluctuations between that particular currency and sterling. Although we do prefer employed applicants, and there is absolutely no requirement for that employer to be a multinational company, we can also review self-employed expats on a case-by-case basis. Generally, we're going to be looking at where they're based, who does their accounts, and what appropriate evidence we can obtain for them. We are also happy to consider expat contractors as long as they have a 12-month contracting history. We have no requirement for a set remaining contract period, And we can also consider contractors that have multiple contracts at once as well. So a case study for expats. So this was recently agreed, and it shows a few of the different factors that we can take into consideration, including foreign nationals, foreign currency, and the fixed term contract. In this particular case, they were looking for a new residential home in England for one of the applicants who was a returning expat, whilst the other applicant was going to remain overseas and then return at a later date. Even if your client's expat case doesn't necessarily match what we've got in front of you there, like I said, we've got over 2,500 product types that we can come up with, which means we really can cater for lots and lots of different scenarios, and our team are more than happy to help discuss it with you and go through it with you. So the next thing is holiday let and complex let. So we have a very broad holiday let and complex let proposition, and we will accept properties that are let via Airbnb, and we will also consider properties that have more than one unit on title, even if those units are actually being let separately. We are also comfortable with unusual property types for let cases as well as residential. Like I say, we will come on to unusual properties in a moment. We offer regulated buy-to-lets. That is another area of expertise for us. So whether your client is letting to a family member or because they want to buy a holiday let that they intend to use themselves for more than 4 weeks a year, there's a lot of scenarios that we can cover with our products. We also offer regulated mortgages for properties that will be let for a period before the applicant moves in, even if they are looking to move in much further down the line. Like I mentioned briefly earlier, all our let cases are assessed on full affordability rather than ICR, but that does allow us to consider properties with potentially a low rental yield or properties that can't be let immediately, potentially because they might need works doing to them before they can be let. We have no prior letting requirement for any of our let products, and that does include holiday lets. And we have no upper age limit on let lending either, as long as it is within normal life expectancy. Short-term letting isn't confined to just let cases. We can give residential consent to let for up to 24 weeks a year. So, for example, if your client lives in the property but intends to spend the summer abroad, like me and my wife like doing, and we want to let it on Airbnb, Market Harborough can find a solution for you to do that as well. So our case study for holiday let, this is actually one of my cases. This came up involving the remortgage of quite a substantial property that the clients were letting via Airbnb. It wasn't straightforward because they wanted to capital raise to buy out a third party. And they also had other buy-to-let properties in the background, which made up most of their income. We were able to consider this, and we looked at the client's overall bigger picture, and we found the right product for them. And again, although this example is a remortgage, we regularly complete on holiday let purchases as well. So I want to move on to high net worth. So we have a very open-minded approach to high net worth clients, especially where they have possibly large property or investment portfolios. It is important to know that we can use income from investments to support affordability, even where the clients aren't necessarily drawing from them or are drawing just a small amount, as long as we can evidence that those drawings can be taken. We offer a much more flexible approach to affordability for high net worth clients because we will take into account their overall wealth and asset position as well as their background, which means we can actually allow for some considerable income stretches on high net worth cases. Like I said, we don't have any loan to income limits, so we can get a massive income stretch on cases. Our maximum loan size is £3 million, and we can offer interest only facilities up to 60% LTV with our sale and downsize criteria, or we can go up to higher loan to values in some cases if your clients do have an alternative repayment strategy as well. To that end, we can also offer part and part for any applicants who want to have obviously part on interest only, part on repayment, or to have additional funds that might have to be on repayment for any reason. So even if your high net worth client wants to help their children or other family members or even their friends, we can also consider this in line with our joint borrower sole owner proposition. So a quick case study for high net worth. So in this recent case, our applicant was obviously high net worth. He was age 67 and he wanted a short mortgage term to age 75. The purpose was to repay his existing mortgage, clear a second charge and an outstanding business loan. He took his income from numerous sources, which included a property portfolio held within one of his limited companies. We looked at all the various sources of income. We established that he was well and truly high net worth because of his assets, and we were able to offer him a £2.5 million interest-only loan to cover what he needed. We were more than happy with the scenario. So unusual properties. So we have actually arranged some mortgages for some very unusual properties, including things like large acreage and stables and all sorts of things like that. We will look at each case individually. We'll assess the bigger picture. So it is well worth talking to us if you do come across an unusual property type. Just to give you a bit of an idea of what we might consider unusual, we've lent on properties that have annexes, outbuildings, multi-units where units are being let separately, multiple kitchens and separate holiday let cottages as well. We will look at cases with listed buildings and properties, like I say, with large acreage, as well as some unusual property types and construction types, excuse me. Our main focus with unusual properties is residential, but we can consider, excuse me, cases that have small elements of commercial as well as unusual property types that might need some form of development. Say they want to develop a disused outbuilding, for instance. It is also worth mentioning that we can factor in any rental income from part-let properties, even for purchase cases, to support affordability. So again, case study. This recent case, I think, is a really good example of a case that sort of culminated all of the unusual property types in one. So we had a couple here who were looking to buy a farmhouse that had, excuse me, 26 acres. Not only that, but it had a holiday let cottage on title. It had a stable, 2 menages, which was going to be used for horse riding coaching, and it also had lots of undeveloped outbuildings and barns. They were also looking for interest only. All we did was we took the whole case into account. We got a bespoke valuation, which provided us with the extra detail we needed, and as a result, we were able to lend them the amount they required to buy their new home in the countryside. Last but not least, bridging finance. So our regulated bridging can be used for more than just sale and downsize. We can offer cross-charge bridging for this purpose, but we're also happy to lend for the residential development, lease extensions, or even potentially business development, where our security is residential in nature, and the clients have a clear and viable exit strategy. We will offer interest roll-up for up to 12 months for the majority of applicants, or up to 5 years rolled-up interest for high net worth clients. We can also offer serviced bridging if this happens to meet your client's requirements. Our bridging loan to value limit is capped at 60%. However, we can offer dual part solutions where the clients potentially needed more than this and they have the income to support a longer term mortgage as well. Our bridging has no ERCs and we have rates starting from 0.44% a month. So our products are very competitive and they also match our flexible understanding approach and our flexible underwriting. So final case study for the day. This case here was for the purchase of a new residential property before the applicants had sold their existing. The property came with 1.5 acres and the building did require some development work. The two properties were cross-charged or cross-collateralized, and a timescale was agreed between us, the broker, and the client, to which allowed the applicants to complete the works required before they move into their new home. We agreed a second charge on their existing home due to having a mortgage already on it, and we agreed an interest-only roll-up facility at 0.58% a month. So in summary, I know we've crammed quite a lot into a very short period of time. I think the key message from Market Harborough Building Society is that we do offer solutions for many standard and complex scenarios. So it is well worth discussing your case with your local specialist lending manager just to see if we can help. There is often, as you know, more than one way to build a case, and that's what our mortgage specialists are there to help you work through. The more information you can give us up front, the better and more reliable answer we're going to give you. So do please bear that in mind when you are putting the case to us. Do hope you've had a bit of a flavour for things to look out for when it comes to those 5 key areas, expats, holiday complex let, high net worth, unusual property types and bridging finance. But there is so much more that we can offer beyond this as well. So it is well worth giving us a call with anything complex. We are a lender to count on. As a reminder, we really do pride ourselves on the way we work with you to resolve your cases, reach the right outcome, all whilst providing reliable answers. We're really proud of this feedback. You can see there. I really do think it sums us up. The service that we provide. We are a lender to count on. So thank you for taking time to listen to me today. Hope you've enjoyed it, found it useful. I am open to any questions you might have. I think there looks like there's one in the comments tab, so I'll answer that. Do accept consumer buy-to-let properties in preemption for buy-to-let and applicants living abroad. Consumer buy-to-let is a bit of a hit and miss for us. Theoretically, no. However, we can accept consumer buy-to-let if the clients are willing to sign our consumer buy-to-let declaration form to confirm that it will actually be an unregulated buy-to-let and it will purely be for investment purposes. We can also do consumer buy-to-let, if it's going to remain regulated and they intend to return to it in the future. Unfortunately, we don't offer consumer buy-to-let, let-to-buy, but we can offer let-to-buy if it's not a consumer buy-to-let. So if you've got a particular case in mind, always give us a call and we can discuss it with you. Preemption for buy-to-let, I'm not 100% sure what you mean by that. I do apologise. But applicants living abroad, absolutely. Expat buy-to-let is fine. Like I say, we don't have to have anybody living in the UK. They don't have to pay UK tax. We can accept expat buy-to-let. It's not a problem at all. Even if it's their previous residential and they're remortgaging as a buy-to-let, it's fine.
Okay, Tom, got a couple of questions that have come through previously. Can you accept pure maintenance income where there is no additional earned income? It is court ordered.
Absolutely, yeah. If it's court ordered, all we need to see is the copy of the court order itself, just to ensure how long it's going to be received for and obviously how much it is. We will potentially look to limit the mortgage term to coincide with how long the court ordered maintenance income is going to last for. But yes, we can accept that, no problem at all.
Okay. Could your bridging finance be used for a client who needs more funds and time to complete his self-build?
Yeah, absolutely. As long as the property is wind and watertight and it is residential in nature, yes, we can take out a bridge as long as there's a viable exit strategy. Obviously, in that case, the exit will probably be the remortgage onto a standard product. So yes, that is acceptable to us as well.
Okay. Philip Smith asked, buy-to-lets above commercial premises?
Yeah, case-by-case basis. It just depends what the commercial premises is. I think it's kind of a bit in line with lots of lenders. If it's above a takeaway or, extreme example, a nightclub, we're probably going to say no. If it's above, a fancy wine bar in London or sort of a Tesco Metro, then yes, we can probably look to accept something like that. Okay,
there was a couple more being typed, but then come up as yet. So this is quite a long question. I have a client who's currently in Qatar working on a contracting basis. He's buying a property in the southwest that has a house and an annex. He intends to use the house himself when he comes home for holidays, but will let the annex full-time via Airbnb. Is this something you will consider?
Yeah, absolutely. Absolutely fine. That sort of, it sounds a bit cheesy, but that's bread and butter for us, really. We get lots of clients in Qatar, in the Middle East, Dubai, Qatar, that sort of area of the world. Yeah, we'll work on full affordability. We will take into account any income that he's expecting from the Airbnb let cottage. And obviously, if he's going to be coming back to live in the main property, that's absolutely fine. We will want to know sort of what's his plans for upkeep and security of the property when it is empty, when he's out in Qatar. So that's just something to think about. But yeah, the scenario is absolutely fine. So yeah, ping that over as an inquiry and I'll look into it further if you wish.
Okay, there is another one being typed, but it's not come through yet. We've got another one here. My client wants to go on a residential mortgage with his friends to help their affordability, but doesn't want to be on the deeds as he already owns a property. He will provide part of the deposit and live in the property at times. Can you do this?
Yeah, absolutely. So because of our joint borrower sole proprietor or joint borrower sole owner, the beauty for us is they don't have to be related. So if he wants to go on his friend's mortgage to support affordability and doesn't want to be on the title, that's absolutely fine. All we would require, in that instance is that he does take independent legal advice, obviously, because he's going to be jointly and severally liable for that mortgage, but has no legal interest in the property. So we would request he gets independent legal advice, but yeah, again, fine.
Okay, and John Scott, hi John, hope you're well, has asked, property purchase first-time buyer who is a UK citizen but lives in Vietnam and paid in local currency.
Yeah, Great question. Thanks, John. Yeah, fine. Vietnam is one of the countries that we do lend to. Local currency is absolutely fine. I think, like I said in my presentation, we will stress test the currency by 30%, just to account for any potential future fluctuation between the local currency and sterling. But yeah, Vietnam is fine.
Okay, there was one. Dawn is typing something now. Hasn't got. I ran out of questions, unfortunately, from my bit. We'll just wait to see if Dawn's come through. Just to mention one thing, in your presentation, you mentioned that the prop fees are paid within 5 days completion. Well, as you'll find out later on, everybody, if you come through us, you're actually paid on the day of completion, because we don't wait to pay you. We pay you only because I only like picking up a file once. So when I get notification it's completed, we ask you for your bank details, you then get paid straight away. So if Market Harborough decide to make us wait, we don't make you wait. So, and
sorry about
that. Would you consider a property what can only be used for holiday let? So there's restrictions within the title, I presume.
I take it that means there's restriction. If it's a restriction, unfortunately not. If it's going to be purchased by the client purely to be run as a holiday let, obviously that's absolutely fine. But if the property has the restriction that it can only be used as a holiday let, then unfortunately we wouldn't consider that, I'm afraid.
All I would say, Dawn, is if it's a case whereby, for example, you've got a property that's overlooking the sea in Torquay, for example, I'm sure we could maybe talk to some lenders who've got obviously issues with anything that's got restrictions, and they're getting to consider it, because some properties can only be used for that type of thing. They can earn a fortune. And I can remember one we did a couple of years ago that was one of the nicest parts of Devon, a penthouse flat overlooking the sea, and there were restrictions, but we was able to place it. So Dawn said it's written into the planning consent and isn't time limited. So, okay. Right, I think, well, we're bang on time. So I was about to call you Liam, actually. I don't know why I was going to do that. Tom, thank you very much for the presentation. Very informative. As you can see, MHBS do stuff that really a lot of others will not even touch. So there is actually just one more slide on this that we added in yesterday. Apologies, I forgot. I only added these on yesterday, which is quite simply, if you've got any needs that want to see exactly what they've got, so you want to download, for example, the up-to-date terms, you need decision in principle forms for buy-to-let, bridging, residential, application form, tariff of fees, any of their other documentation, everything's available at lenders.specialisthub.co.uk/MHBS. Just go to that. That address is on the flyer we sent you. So you can get literally everything you need. The idea is that eventually our website will be the go-to place to get lenders documentation, because we've got a procedure in place to make sure everything's up to date. Whereas many lenders don't tell us when something's changed. We're going to make sure that we know before, quite often, the day it changes. So, Tom, fantastic. Thank you very much indeed. So,
thank you, Tony. Thanks, everybody.
I'm going to go on to the next one, which is the next introduction, which is Christian Gugolz from MT Finance. And there he is. Okay. Again, what you need to do, delegates, is just grab hold of the 2 pages MT Finance documentation. You'll see we've scanned one of the pages there. Just grab that, because that's got basically all their product range in there at the moment. A little bit on Christian. He joined MT Finance from a loan brokerage, Amiga Loans, where he focused on the development of its commercial bridging and secured loans business. He started his career at a legal recruitment company before moving to a commercial outsourcing solutions firm, where he held the position of national account executive. He covers London and South East. Christian is responsible for introducing new brokers to their panel in this region, as well as strengthening MT Finance's existing relationships. Christian, can you hear us?
I can indeed.
Fabulous. Okay, so no techie problem so far. Good. It's looking good so far. Okay, now, as I've already mentioned, we ask all speakers for an interesting fact. He was very, very modest and said his only interesting fact was he was born in Switzerland. I thought that was a bit boring, so I then stalked his LinkedIn.
Thanks.
Found out that he's a big Supertramp fan. That's a group from the 70s, I suppose you could call them a 70s supergroup. And one of his brokers said in a post on LinkedIn, having Christian as your BDM is like ordering 10 chicken nuggets and getting 11. So, which I think is nice that he's actually being compared to a bit of chicken. But I then also decided, because I think he's being far too modest, because this is what happened over lockdown. He was the brains behind the LinkedIn Golf Bucket Challenge, which I wasn't invited to, because he's obviously heard I'm the world's worst golfer, which took place during lockdown, which raised more than £8,000 for the NHS Heroes. So a virtual round of applause for Christian, please. just whilst I now sort out his slides, and then it's over to Christian.
Right, good to go?
Yeah, just coming up now, all yours.
Fantastic. Good morning, everyone. Obviously, just big thank you to everyone for joining today. Hopefully, I'll be able to give you a bit of an insight into MT Finance and what we do, how we work, and how we could potentially kind of help you with your clients for their bridging needs going forward. So, my name is Christian, obviously. I'm the Senior BDM for London and South East. We are, so MT Finance, if some of you don't know, actually stands for Mutual Trust. We've been going since 2008 now, so just around about 12 years. So obviously they started this particular business in a very bad time in the market. I started back in 2016, so just nearly 4 years ago now. When I started, there was 8 or 9 employees. So in the last 3 or 4 years, we've actually increased, doubled the size, more than doubled the size, up to 32 members of staff. That's all the way from case managers to new business to the back office, BDMs, directors, etc. So we have grown considerably over the last sort of 3 or 4 years. You'll notice there as well, we won 20 awards in our time, most of which I think are for service. So you'll soon see, you'll kind of, when I come onto it, a lot of what we do, we pride ourselves on the service that we provide. So just going straight into it, really. We're a very straightforward bridging finance lender, so we're unregulated, and what you would have called previously non-status. It's not so much anymore. We do look at slightly more information, but effectively we're an asset-backed lender, so we're focused on the asset more as opposed to the actual client. So as you can see there, we cover a range of different areas, going from residential, semi-commercial, heavy refurb, and commercial. On the residential side of things, we do first and second charges, both of which we currently max out at 65% gross. We were, prior to lockdown, up to 70, but as you can imagine, the market has changed somewhat since beginning of March, probably January actually. So we kind of maxed out at 65% gross, but what it is worth noting is that we are actually working off open market value 9 times out of 10, as opposed to 180. So I think from what I've seen in particular, the 180-day value is slowly becoming closer and closer, I think, to the open market value. But generally speaking, 65% gross of your open market is sometimes actually more than your 70% of your 180. So it's always worth bearing that in mind. Second charges, again, up to 65% gross. A big one for us over the last few months has actually been second charge for business purposes, particularly on clients' main residences. I think where these smaller companies have been struggling potentially with cash flow or stock or whatever it is they need, we've been able to do second charges, not only on investment properties, but also on a main residence. So anyone who is looking to borrow money for a business purpose, we can look at doing that across their main residence as well as an investment property. Rates start from 0.69, ranging all the way up to 0.85 at 65%. So we are very transparent in what we do. We know we're not the cheapest on the market, which is why we have to provide one of kind of the service that we do. So we try to be as transparent, take a common sense approach where we possibly can. Not having the cheapest rates, obviously you have to start doing something slightly different when it comes to service. Excuse me. We can also look at development exits on the residential side. We don't have a specific product for that, but we effectively would look at that underneath the residential pricing. It will largely depend on obviously what works are left to be done. So we'd like to see obviously what's left to be done if there is anything. If not, then great, then it does make it slightly easier. So we can look at those as well. And that pricing does tend to be the same as the residential side of things. Semi-commercial, again, first and second charges. We're a big fan of these, mainly because obviously you've got the residential element to it, and our main focus is residential. So it's good to have both. Tends to be obviously your retail below and your uppers. We're seeing a lot of conversions of those as well at the moment. So that type of thing we can look at. I'll come on to a second in the heavy refurb side. Again, we're max 65% gross, rates from 0.85 on that side of things. Commercial, we are first charge only at the moment, currently at max 55% gross. However, we do often try to look at 60 wherever we possibly can, on the more kind of straightforward commercial assets. So if you're looking at kind of a retail shop in a high street, something like that, it's slightly more straightforward. We'd look at that. And rates on that side run from 0.85%. On the heavy refurb, we're slightly, I wouldn't say different. I think a lot of lenders work very similarly when it comes to heavy refurb, particularly your bridging lenders, because it's not development. It's kind of it's in between your light refurb and obviously your development. So we're up to max 65% day one. Max loan to GDV would be 60%. So that's the whole facility across the board. Currently, because of the market, we did actually pull this product over lockdown, because I think it was difficult for people to get hold of materials, to get contractors in, etc. So we actually pulled it. We've brought it back in the last kind of month or so, which is why we're maxing out at the moment at 500,000 on the loan size. Rates start from 0.8. We can provide up to 100% of the costs. However, we would be looking at a maximum of 70% of the cost of the current value. So the works can't exceed 70% of the current value, if that makes sense. Any questions, obviously, just let me know on that. So that's kind of the basic parameters. Just want to kind of move on to your, what makes us different, really. It's probably look at that slide and laugh, because obviously most bridging lenders are very, very similar these days. We, as I mentioned at the start, we are kind of what you would say was a traditional bridging lender. So when you look kind of like 10, 15 years ago, obviously, we're very similar to that, but just obviously with a cheaper rate. So we take an asset-based lending decision. So we don't really look at the client as much as most lenders would. So it's a case of understanding what the asset is, what the purpose of the loan is, how much they need, what the exit is, etc. And then we don't really look at income or affordability. There are occasions where we'll ask for assets and liabilities and some experience if it's a heavy refurb deal, but generally speaking, it's the asset that we're actually interested in. For limited companies, we don't require any PGs, which I know a lot of people love. It's where we get a lot of the business. So that's kind of one of our expertise. We try to take a very pragmatic approach in our lending. So I think we don't have a system as such. So every deal that comes in, we'll have a conversation, we'll look at the deal. Everything's case by case basis. So it's a common sense approach, not a computer saying yes or no because of the criteria. We'll often look to kind of go outside of criteria if we can. If it's a deal that makes sense, then we will look to do it. From an inquiry perspective, we only have a one-page inquiry form, which I know for some of you will be music to your ears, because I know you probably spend a lot of time actually filling out inquiry forms. So from our perspective, it's a one-page inquiry form, and that will get you an offer in principle, which is effectively fully credit backed and underwritten, because we don't have a credit team as such. It's all done front end. Types of borrowers, we'll look at a range of those. So personal borrowers, obviously, LLPs, expats. We'll also look at limited companies, obviously. Foreign nationals is an interesting one. We had to adapt quite a lot over lockdown, purely because, obviously, generally speaking, we would normally ask clients to fly over to sign all the documents as such. Obviously, during lockdown, we weren't able to do that because nobody was able to travel. So we had to adapt slightly. So we now actually accept solicitors that are based within that country and have an office in the UK, which we would like to obviously review first. And then all the documents can be kind of witnessed by a third-party adult. So we have had to adapt that, but it just makes it slightly easier from your perspective if you have any foreign nationals. We'll also look at kind of foreign nationals with no footprint within the UK as well. So as I said, it's completely asset-based, mostly asset-based. Fit for purpose, transparent terms. Every set of terms that we send you out, you'll see exactly what is being, exactly what the terms are. So you'll see what the gross loan is. You'll see exactly what the interest is, what the legals are. Everything is there for you to see. It's very, very transparent and very easy to understand. we generally at the moment we have terms are generally from anywhere from 3 to 24 months. We are trying to do most of what we're doing at the moment is 12 months retained because of the market. It's more, properties are more difficult to sell. It's more difficult to potentially refinance. We are looking at 12 months most of the time. We can look to do shorter or longer, depending obviously what you need. The good thing on that is there's no exit fees or ERCs. So if you take a 12-month term, redeem after 6 months, you're only paying 6 months interest. And on that, we only have a 1 month minimum term. So even if they redeem after 2-3 months, you're still only paying 2 or 3 months interest. As I mentioned, speed, service, and transparency. So we have a very experienced team of underwriters in the office who kind of know what they're doing. I hope anyway. One of our directors is actually a legal underwriter by trade as well. So we have a very good stance when it comes to making commercial decisions on the legal side of things. So it's not a case of us having to rely on our solicitors to go and ask them a question for them to come back to us and give an answer. We can actually have a conversation with one of our directors, and they can then give us the answer. He can give us the answer pretty much thereabouts there and then. So quite straightforward. So the process again is very simple. There was a couple of bits I've mentioned already, but it is kind of we do what we say we do. So to apply, there's a few ways. You can call us, you can send us an email, you can apply online. But again, with application, there's only a one-page new inquiry form for you to complete. On the back of that, we generally get an offer in principle out, providing that there is all the information required. We will get you an offer in principle out within 2 business hours. If the deal is slightly more complicated, then obviously it might take slightly longer just to review the deal. But generally speaking, a couple of business hours, we'll get that offer out to you. With regards to that, as I mentioned earlier, it is fully underwritten and fully credit backed, just subject to, excuse me, subject to valuation and legals. As soon as the client has signed, send that back and pay the valuation fee to us. We'll instruct the solicitors. And if the client is quick in paying the legal undertaking as well, we can actually run the valuation alongside the legal work as well. Obviously appreciating that some clients wouldn't be willing to provide the undertaking until such time they've had the vow back, because there could be down vows, etc. There could be something coming out that we weren't aware of. So that is as simple as it gets, really. Very straightforward. We try not to ask too many questions. We try to make it as easy as possible for you guys as well. The only thing that you really have to provide to us alongside the new inquiry form is a copy of their credit report. We don't actually run credit checks ourselves, so the credit report is mainly just to check for any bankruptcies or IVAs that we can't actually lend if that's the case. We can lend if there's adverse credit, CCJs, those types of things. We just obviously want to review it just to make sure we're comfortable with it, but from that side of things, we're okay. So I just want to run you through a couple of case studies. So semi-commercial auction purchase came to us with only 3 weeks to complete. We managed to kind of get that, take a fast proactive approach, allowed us to complete the transaction in just 10 days. So the way in which we work, it just allows us to move quickly. So our solicitor was working from home as well, but arranged to meet the client with the client to sign the document. So very easy to use. And then obviously the 17-month term gave them plenty of time to carry out the works and significantly increase the value of the property as well. Just seeing that question come up at the bottom. If they have had missed mortgage payments, but they are back on track now, then we're okay. If they're in default as it stands now and they're kind of 2 or 3 behind, then we would have to we would have to look to take the first charge out. We couldn't do a second charge behind that, but we could look at doing a first charge. So just to reiterate, if they have had missed payments, we can consider them, providing they're up to date now. Hopefully that answers your question. Second charge to fund work. So obviously I mentioned at the beginning of the presentation that we do second charges across the board at 65%. So this client needed funds to complete the works on their investment property, but their lender had unfortunately pulled the day on the loan, the day the loan was due to complete. So we reviewed the case, obviously, to try and find a solution, obviously, for social distancing issues. So we actually accepted a retype of the valuation report from the previous lender, which was also obviously supported with an audit from one of our panel surveys, obviously, just to give ourselves a bit more comfort. So in just 3 days with that, we actually provided a £490,000 second charge over their investment property at 65%, serviced at 0.75 over a 24-month term. So it gave the client the funds he needed to carry out the works in obviously time to increase his investment property, which he was then able to sell against the higher value. So another good example of the second charge and how that works there. Again, if they had an investment property and they were maxed out on their loan to value, we could actually look to raise a second on the main resi to help them complete those works. And finally, so barn conversion. So these are an interesting one for us in the sense that, as I said at the start, on our heavy refurb products, what we do is we do day one, we do 65%, and then we work on a revaluation basis. So day one, 65%. Client would obviously would have to use their own funds to start the works, and then generally speaking, as long as the property increases in value, we can then look to do further drawdowns against that new value. I believe on this one, the client was able to fund the initial works, so the remaining funds were then released in stages in arrears. It just allowed the project to be more cost effective for the client, and obviously he was able to exit the term by selling it at a high value. It's worth noting that this product generally works better when the property is unencumbered, so we can actually lend against the asset for just the works. The revaluation model, it does work, but it just depends on whether or not the client is going to add value in the first couple of months. If the client's spending sort of money stripping the property back initially, then that's obviously going to bring the value down. So there is actually no room to lend any more funds. And I think we're there. So if anyone's got any questions, I hope I didn't talk too fast and covered everything. So anyone's got any questions, obviously let me know.
Christian, absolutely perfect. You're dead on 11:05, so that gives us 10 minutes for questions. And if we didn't have enough questions, then we will get the break a little bit early, which is good. We've got a couple of questions that we pre-prepared. So how quickly can you complete a loan is one question that was asked. Good question. So generally speaking, it does largely depend on how quickly the client solicitor works. Excuse me. So from start to finish, so from client signing the offer and kind of going down to drawdown, it's generally 2 to 3 weeks. More kind of 2 weeks for your first charges. Second charges take slightly longer because we have to get consent. But it's always worth speaking to the client day one just to make sure that their solicitor make sure that their client has a solicitor that is experienced in bridging. It's very often that we have solicitors that are working on our cases that generally haven't done it before, so it does slow it down. Providing the client does want to complete quickly and the solicitor works quickly, we can complete within 2 to 3 weeks. Okay, and what trends do you predict for the bridging market? Get your crystal ball out. It's an interesting one because there's a lot of lenders that have obviously pulled out. There's a lot of lenders that are coming back. I personally think, I mean, I don't know if anyone here has ever seen the bridging trends that we do. So we get a number of a number of brokers provide us with data, and the trend at the moment is that the regulated bridging is actually flying. So it's the highest it's been in the last, I think, 5 or 6 years, and it's actually overtaken the unregulated. So I think the bridging market in general is going to continue as it is. I think it's always going to be a viable option for clients, particularly investors now, to get properties quickly because the competition to buy properties is so big. But in general, I think the regulated market is going to fly, mainly because of the stamp duty. I agree. I mean, we are now seeing more inquiries for regulated than we are for non-regulated. So yeah. It's very underserved at the moment, unfortunately, within the bridging market. There's just not enough lenders in it. But yeah, the ones that are in it, they're right in buckets. So
yeah, I can imagine so.
I'm just going to mention one thing. Christian mentioned about they require a credit report. Well, as you'll find out later when you hear my second presentation, because of our involvement in the second charge industry, we have access to 8 different Equifax and Experian accounts. So that means that we can get a credit search done literally within 30 seconds of getting the inquiry. So that will be sent to MT Finance. So rather than having to wait for the client to get something from Equifax or Experian, we would submit that with the inquiry. So one thing I'm going to say about MT Finance, really were one of the most proactive lenders, bridging lenders throughout lockdown. They really were. They were a godsend to a lot of brokers out there, where others really did fail and just didn't deliver. They did massively. And these things like that just aren't, they're not forgotten. They're really not. So
hopefully
we've had a relationship with MT. I haven't done enough business with them over the years really, but we've had a relationship with MT Finance right from when they started.
Yeah.
And I met their 2 directors at some trade show, and it was literally just them and no staff.
Yeah.
At that stage. So it's been a long time. I was talking 2009, I believe that might have been. So there isn't any questions. If anyone's got any questions, you've got probably about 20 seconds to ask them. But other than that, if there isn't anything,
I think I've been let off lightly.
You've been let off very, very lightly. I think next time we're going to come up with some really, really tough ones for you. We're going to get to sing some Supertramp numbers, maybe. Next
time.
Yeah, no problem at all. But no, there's nothing there. Well, thank you very much indeed. Okay, welcome back, everybody. It's just gone 11:20. So what we'll do now is we're just adding on Andy Virgo as a presenter. So hopefully everything will continue to work the way it should do. Andy is a long-time friend to Specialist Financial Services, known him a very, very long time. And he really is one of them. I'm not just saying this to blow smoke up his you-know-what, but he really is one of the nicest guys in the industry. So he has been added on, good, and he's about to come on. You'll see him. You can actually compare photo now and photo. Yeah, no difference at all. He's even wearing the same shirt by the look of things. Right, okay. So delegates, you need to grab hold of the Lendinvest leaflet that we sent to you in the post. We've also emailed to you this morning. It's a 4-page document that we printed on A3 paper. If you've had it in the post, so just make a grab for that. A little bit on Andy first of all. Joined Lendinvest from Interbay Commercial in July 2017 to assist in the development of Lendinvest's entry into the buy-to-let sector. Previously a senior BDM within the OSB group, Andy worked as a commercial mortgage broker with Christie Finance and established a property finance brokerage in 2006 after a stint with NatWest Bank in the real estate team. Initially charged with product development alongside broker management, Andy took on the role of head of key accounts when Lendinvest joined forces with the industry's mortgage clubs and networks. After winning the NACFB Best Buy-to-Let Lender Award in December 2019, Andy was subsequently promoted to Director of Buy-to-Let, thus responsible for the development and subsequent success of Lendinvest buy-to-let proposition, which I must admit has been incredibly successful. One of the best launches that I've seen from a lender. Something completely new into the market as well when they launched it, which has now been copied by several lenders as well. Yeah, really was very, very impressive what they've done, and we were glad to be a part of it right from the outset. So his interesting fact, which I'm not going to actually explain, I'll let him explain this. You might be surprised to learn that Andy once broke his leg in a swimming pool. So Andy, whilst you're explaining that, I'm going to put your slides on. Okay, so just a quick 5 seconds.
I was a young lad with the, and anyone around my age might remember the I Spy book of something, learning to dive. I had an I Spy book of learning to dive. It said, sit on the edge of the pool and then just lean forward and fall in. They hadn't catered for the fact that there was a bar that ran around the side of the pool for you to hang on to when you're in the water, and my leg went behind it, and I broke it. So yeah, painful.
Ouch.
Yes. So over to me. Good.
Over to you. Yeah. I'll see you in 15-20 minutes. Andy, over to you.
Good stuff. Thank you, Tony. Yes, Lendinvest. We have been making quite a splash over the last 3 years about our buy-to-let proposition, which is, as Tony said, growing We're only 3 years into it, but it's growing, and we're doing really, really well actually so far, and there's more to come. A little bit about our company. So back in 2008, Lendinvest were initially established as a company called Montello. Montello, purely bridging, very small lender, a couple of 3 people working in a dark office with no windows, looking to lend as much money as possible. After initially taking some time to get off the ground, momentum started, and the company eventually changed its name in 2013 to Lendinvest, which kind of alluded to the fact that we wanted to attract investment into our business and ultimately lend that money on. Perhaps an early part of the what's it called? The peer-to-peer, an early sign of peer-to-peer, but we never actually jumped on the peer-to-peer wagon, in that we didn't actually take those investments onto loans, apply those investments onto loans. We just literally used the money on a general basis. Secured some phenomenal funding back in 2016 from Atomico. Atomico was set up as an investment company owned by the guy who invented and then sold Skype. So that was a significant part of our growth. Just before that, we'd launched into the development market, helping people build properties, residential properties, not self-builds, purely properties like small estates, small projects, and that is a very big part of our business today. So as it stands here in 2020, I'm just about to talk you through where we sit on our buy-to-let proposition, but effectively we are a bridging, development and buy-to-let term loan lender. So what a year. Where we've been this year is quite incredible. We all, you know, nobody's obviously going to be surprised by the fact that we've had a bit of a tough one as Lendinvest, as have all lenders. Some of us have coped with it differently than others, and I'll explain what we've done here. But let's cast our minds back, because this is important actually, to look at where we were in January and February this year. I mean, we were flying as a business. It absolutely was. We were going great guns. We had a £1 billion forecast for buy-to-let lending for the year. It was going to be a phenomenal year. Loan to values were up as high as 80%. We were quite happily providing loans at £3 million. Rates were starting at 2.89% on the 2-year fixes. You know, it was a fantastic proposition, and competition was rife. We were properly busy. We were slick. We were providing quick turnaround on deals. But then, as I returned from holiday from Egypt at the beginning of March, I was greeted by broker meetings being cancelled. We were having all sorts of emergency meetings in head office. Then the toilet rolls were out of stock everywhere. Quickly followed by us locking down our business. Everybody went to work from home. But as a fintech business, we were able to do that. We were able to provide a service that kind of didn't change from what we were doing when we were in the office. So whilst around us there were some lenders closing shop, there were some lenders reducing their loan to values down to kind of 65%, which wasn't really anything that anybody wanted at the time. And then eventually lenders were scuppered by the fact that the valuers couldn't go out. We were sat with a full bank account. We'd sold our loan book literally the Friday before the Monday lockdown, that 23rd of March when we locked down. The Friday before, we sold our about £284 million loan book. So our shelves, our warehouse was empty. We had the ability to lend money. We had all the money to lend, but with no valuers going out, there was not a lot we could do. We worked really hard to find a product where we could do desktop valuations, and we actually secured a solution. We secured something called Buy-to-Let Plus, which was something for us to continue doing buy-to-let completions with using desktop valuations. The trouble is, about a week after we secured that, we ended up breaking the lockdown and the value has started coming back. So when we lock down again, we're well prepared. I didn't say if then, I said when we lock down again, we're well prepared to continue lending on a buy-to-let basis by using desktop valuations instead of physical valuations. So where are we today? We're still not in the office. I've been working here in my spare room now since the middle of March. I haven't left, I haven't had any holiday. I'm due off next week to go and sit in a field with my caravan and my wife. But we're working from home. We've furloughed the sales team, we furloughed a lot of the business, we've made some changes. Everybody's back now. Everybody's working from home. We're thinking about opening the office in October. We're not making it mandatory for people to come back. Such are the issues with travelling around London on the undergrounds and trains and whatnot. The thing that we've been doing through all of this lockdown is listening to everybody in the market, listening to brokers, listening to you guys, listening to the feedback from the likes of Tony and his team, who gather lots of information from all of his contacts. We've been looking at the market, we've been researching the market. It's been incredibly strange times for all of us. And when you're lending money to the tunes of the many millions, hundreds of millions that we lend a year, we have to be very, very careful how we do that. We have to be a responsible lender. You know, I've written here, we need to take a measured approach to lending. And that doesn't always mean giving clients exactly what they want. Borrowers can be a bit fickle. They want all of it and they want it now. They want 85% loan to value. They want no experience, you know, first time landlords. But is that prudent? Is that right to be giving that advice to a borrower to kind of move into a market now or get such high loan to values that might lead them, if property values move down, especially in HMO and multi-unit freehold block areas? You know, what is that good advice to be letting these people move into new sectors? So it's all about being very careful what we do. That said, it's gone mad. Business is booming. It's blown the doors off. If I'd been able to get a decent picture there that had a roof being blown off the building, then I would have used that instead. So the volcano has to work as the metaphor. We are absolutely snowed. And our proposition's quite standard, quite vanilla, and I'll come on to more about our proposition in a moment, but it's pretty important that you understand who we are as a business so you kind of get how we work. There was a period back in 2019, January 2019, we'd just come back from Christmas and Fleet closed. They'd lost their funding line, their arrangements with BlackRock, and they closed. They were closed for 2 or 3 months. We, coincidentally, had just launched a very aggressive product set. We now refer to that period internally as the tsunami. It went mental. We had people working Saturdays, Sundays, evenings. We were all going into the office and packaging cases. It was mad. We are not seeing levels at that tsunami, record levels of applications and inquiries at that level, because it was madness. But it's the biggest period we've experienced since. And as I said, it's with quite a straightforward, standard, vanilla buy-to-let proposition. It's great also to see that more brokers are dealing with us more often. You know, we haven't been trading for 3 years in buy-to-let yet. After 2 years, our 2-year anniversary, we won an award, which I'll come on to in a minute. But, you know, we've only been trading 2 3/4 years. And we are already seeing, you know, we've completed close to 4,000, actually we've completed 4,500 deals now, which is pretty strong for a new lender in the market. So what's driving all this business? What's driving the volumes for straightforward cases? Well, it's the stamp duty holiday. You know, it's in the press, it's everywhere. It's something that a lot of people are taking advantage of. We deal with the professional landlord, and by dealing with the professional landlord, we want to make sure that we work with borrowers who want to keep coming back time and time again. So there are things that we're doing at the moment to try and entice more people to come back to us more frequently. Currently, purchases are outweighing remortgages. Historically, you'd have said 40% purchase was pretty much the norm. Sometimes it's even lower. but we're now about 58% of our cases are actually purchase, which has not been seen for so many years. The issue that we're finding is that, or rather the feedback from the press and the feedback from other lenders, is that the increase in the volume of stamp duty driven applications and purchases is going to cause a huge headache for conveyancers and solicitors. So lenders are actually going out at the moment and saying people need to consider actually deciding whether they want to purchase a new property by maybe as late as the end of December, allowing until March 31st to get those applications through lenders and completed by the solicitors. The issue is the fact that the current version of the Help to Buy offering finishes on the 31st of March too. So yeah, they're right. There are a lot of issues. There are going to be a lot of issues ahead with people being able to complete cases if they're making applications in February next year. We're prepared for that. We're putting a lot of work in at the moment to identify ways where we are able to accept applications for people who want to take advantage of the stamp duty holiday even as late as February next year. And we're going to be prepared for that. So whilst there is plenty of press out there, you may have seen it yet, you may start to see it now we're talking about it. There's plenty of people talking down the opportunity with stamp duty. It's important you focus your clients on making sure they make quick decisions, but hey, watch this space. We're going to be there for people right at the 11th hour. So in order for us to assist people that are looking to grow their portfolios, we've introduced something called appetite statements, which I'll come on to a little bit more because it's pretty revolutionary and plays right into your hands as brokers as well as the borrower's hands as well. So what is it that we're doing compared to back in January and February this year? Well, we're at 75% loan to value currently. It's a sensible loan to value. We've been back here since the end of July. And if you look at our top selling products, it's all 75%. Lower loan to values just aren't hitting the mark at the moment with the borrowers. You know, we've got rates there at 2.99% for a 2-year fixed. That's 65% loan to value. It's about our sixth most popular product because people are looking for leverage. We've got the payment deferrals going on. We've got the government loans. We used to call the payment deferrals payment holidays. We suffered particularly well through the payment holiday issue. It didn't cost us as much of money as it did some. Being a non-regulated lender, non-bank supported lender, and with no support to cover payment holidays, payment deferrals, we had to suffer that cost off our own back. We're down to about 4, I think now, payment holidays left. All the other payment holiday, payment deferral cases the monies are being made up as we speak. So we're okay as a lender to accept people who have had payment holidays. We're okay as a lender to take applications from people who have had bounce back loans. You can't use bounce back loans or any other government loans for deposits. No, not at all. But we use something called open banking, which allows us to get a snapshot of the client's credit position, and that gives us everything we need to make the right decision quickly. We're enticing people to purchase standard property by charging a £150 valuation fee. That's something that we had back in January. We've retained it. And not only are we giving £500 cash back towards 5-year fixed rate products. So if you take a 5-year fixed rate with us, you get £500 cash back on a standard property. We're adding £200 to that if you allow the use of open banking. Open banking speeds up the process for us, gets you the offer quicker, gets the client in front of the solicitor quicker. It makes absolute sense. So where are we in our products set, and what do we lend on? Well, quite straightforward. We've got 3 areas that we lend in. Standard buy-to-let properties. Those are your standard houses and flats, the sorts of things that everybody would do all day long. Flats above commercial. We do get a little bit picky, we will admit, when it becomes a flat above a fast food restaurant or a property close to something that we call noisy or smelly. Might be a pub, it might be a nightclub. might be a laundrette, or it could be some sort of restaurant or takeaway. So we're careful of those proximity to those types of properties. In our HMO proposition, we have 2 products. We'll lend up to 6 rooms. 6 rooms in an HMO, that's our small HMO proposition, and those properties are valued on bricks and mortar, assuming vacant possession. Some people call it open market value. We also have a proposition for larger HMOs from 7 to 10 rooms. Historically, we would have gone up to 15 rooms, but that's not a market we want to be in at the moment. 7 to 10 rooms, and we would value those on an investment basis. So we would look at the yield that's being generated, and we'd get a long form valuation. We've got multi-unit freehold blocks, effectively a property that has multiple flats and multiple units in it, and something that we will lend up to 10 units. With loans to 3 million on multi-unit freehold blocks, loans up to 1 million on HMOs, we are doing a lot of business in those areas, and we're sourcing well on the sourcing systems too. In terms of rates, you'll have these in your guides, but I just wanted to highlight that what you have there are rates that in the sourcing systems put us on the first page. It's only Vida that are ahead of us with their return to market rates, where they're going for a very, very quick share of the market as they look to bounce back from being closed for 6 months. But they're unproven, and how loyal are brokers to a lender that let them down very quickly during the credit crunch. So here we are with some very good 2-year, 5-year fixed rates. We stress everything at 5%. By stressing at 5%, you'd have to have less of a rental income to achieve the loan to values that you're looking for. We have a pay rate product at 4%. We stress at 4%. So these interest rates were market leading. In terms of fees, we're at 1.5%, which is less than some of those lenders that have slightly lower rates but charge higher fees and stress at slightly higher interest rates. That's why we appear so highly on the sourcing systems. So what are we doing to process these applications quickly? Well, it's all about service with us. We're a fintech lender. If you haven't heard of the term fintech, it's using technology within the finance industry to speed up the process. All our applications that our brokers make are online. There's no need for printing off paperwork and signing documents. It's all done by e-signature. You could be out shopping and you could be signing your mortgage agreement. It's so simple. We don't ask for proof of ID. We send a client an app called On Fido, where we ask them to take a photo of their passport and a selfie. And the biometrics in that enables us to do the ID, work out the ID. We use online payment for valuations, and the open banking, as I said, which as a solution is making it very, very quicker to get these applications through in time. But coming on to open banking, I just want to talk about it a little bit more. So these cashbacks we're offering, there's not many, hardly any cashback offers out there in the market at the moment. I know there's one at £250 from one of our peers I was looking at this morning. I think the other biggest is about £300. So we're offering £500 cashback towards legals should you want to take a 5-year fixed rate product. By using open banking for any application, we will pay you £200. People need to do a little bit of research into open banking. I've just put something on LinkedIn today with a video encouraging people to understand what open banking is. It is not a way to steal banking information. We do not get access to people's bank statements. We just get a snapshot of the financial position. We do not get people's passwords that we pass on to people to go and target bank accounts for illegal activities. Open banking is regulated by the FCA. It's an initiative set up by the government, and I'm quite passionate about it because it makes the job easier for broker, borrower and lender alike. It is the future, and the sooner people jump on that bandwagon and agree to and understand it, the better it will be for everybody. So those cashbacks, quite an incentive for people. When you look at our dual representation, legal fees are about 760 quid. to be actually getting £700 cash back towards those legals is a very, very strong reason to consider Lendinvest. So when do you consider Lendinvest? You consider Lendinvest if ever you're thinking about or you're dealing with any of these lenders here. These are our peers. These are our immediate peers who we work against. You know, it's competition. These are the people that we work with and we get on with and we like and like us. But these are the people that if you're thinking about dealing with them, then you should be thinking about Lendinvest. We've got a brilliant intermediaries website. We've got a brilliant relationship with Tony and his staff at Specialist. They understand how our process works. Contact Tony and he will make the journey for you as straightforward and simple as it can possibly be, based on the fact that we do so much business with Tony and his team. But if you're considering using these lenders at all, stop, think about Lendinvest, and as such, consider us when it comes to researching your next buy-to-let application. So coming to an end, we've identified that leverage is key. We're making some changes to our proposition that I'm working on this morning and this afternoon that I might allude to in a minute if Tony asks the right questions. But you'll be seeing some changes to our proposition next week that will see leverage change. We've got market leading rates. There's the cashback. We do keep it simple. And it's nice to be recognised by our peers, by the brokers. We were voted the NACFB Buy-to-Let Lender of the Year last year. We deserved it. We were grateful for it. We were grateful for the support, and long may it continue. Any questions? Tony, you're muted.
Oh, always helps you put your microphone on before you start speaking. There hasn't been any come up yet, and I don't appear to have anyone typing. So, as always, here's some questions I prepared earlier. Any sign of Lendinvest increasing LTVs?
So, Tony, when we spoke last, I think that was Tuesday, my answer would be no. Today, my answer is yes. I'm not going to say any more, except to say, so I'm contradicting myself, except to say that off the back of some lobbying and some market research, we're going to be moving to 80% loan to value next week, subject to it getting signed off tomorrow. And that will be alongside some other changes and enhancements to our proposition as well. So watch this space.
Okay, so that means, everyone, that the document we sent you is about to change again. So keep an eye. What I'm actually going to do, Andy, we have got more questions to go, but I just want to put this next slide up just in case anybody wants to. Is anything they want to see what's actually available? But next question I've got is, how are you coping with all this business? What are your SLAs?
Oh, interesting one. I got in a debate on LinkedIn the other day about SLAs, in that some brokers were finding it very hard to get through to lenders because lenders in general are struggling with the numbers. We are lucky that we have a full complement of staff, and many lenders have still got people on furlough or have made redundancies. Our SLAs are not back where they were in January, and that's for two reasons. Number one, the volume of business, and number two, the poor level of quality of the submissions that we get from some of our brokers. We ask for three things. Tony and his team at Specialist Finance are not on our naughty list, let's put it that way. But we do have a naughty list of lenders where, borrowers, brokers even, I'll get it right, where even supplying just the three basic pieces of information we require at application, which is proof of deposit, if it's applicable, SA 302, and background portfolio. That's all we require at application stage by way of extra information above name and address. And believe you me, there are brokers out there that cannot provide that. So from an SLA point of view, we're spending too much time chasing poorly submitted applications. The applications that are coming in, that are submitted correctly, are going from application received to formal offer in 14 days. Unfortunately, there's a problem with the number of valuations that are being instructed across the market at the moment. So valuers are now struggling to get the valuations back to us within the 2 or 3 days that we're used to. So those delays are pushing out the SLA slightly. But a properly packaged application with a valuer that can go and access the property quickly, an application received to formal offer should be received and see a 14-day turnaround.
Excellent. Okay. We'll try and start off that naughty list. As you can see, everybody, go to lenders again. This is on the, I believe it's on the back of the document we sent you. You now go to lenders.specialisthub.co.uk/Lendinvest. All documentation is available, including a very, very handy link to Lendinvest buy-to-let calculator. So if you want to know if a deal fits right from the outset, without even like picking up the phone and speaking to anybody, just go onto that. If it doesn't fit, if you think it just fails, it's always worth making a phone call anyway, because in certain circumstances, there is a minor degree of flexibility because they're not regulated by the PRA. So they're not subject to the same rules everybody else is. Basically, there's everything that's not all the documentation that's on there, and we are today, I believe, adding on all their bridging and development documentation as well. So there's going to be everything is going to be there that you need. Still haven't got any questions, Andy. So you've obviously ticked every box that was there. There is no questions whatsoever. So what we'll do in that case, Andy, thank you very much indeed. Fantastic as always, and looking forward to these 80% products. Let me know. Everyone, just keep an eye on your email because we will let you know when that has gone live, and we will have a new one of these product guide to download for you. So, Andy, thank you very much indeed. We will now move on to our final lender speaker, and I will just find their introduction. And he's now going to be added on, and he's going to go. And so we now have Ollie Greenspan, who is from Octane Capital. And everybody, what you need is this document. You can probably see it on the screen anyway, but that document, which is a 4-page, you've got the lender's terms in the middle, and then a bit from their CEO on the back. I just knocked over my microphone. And so here comes Ollie, and hopefully, Ollie, when you can hear us and see us, just say something so we know that you can speak.
Hello.
Yeah, good, excellent. Right, so a little bit on Ollie first of all. He joined Octane in November 2017, started his career in futures trading, where he helped build one of the UK's first algorithmic trading systems. Ollie moved into the world of financial intermediaries of Octopus Investments, heading up their new business team and then helping to found Octopus Labs. I presume that's laboratories. Is it? Right, okay, not Labradors. Okay. Ollie joined Octane shortly after inception and spends his time trying to make them the easiest lender to do business with. A little bit on Ollie. He's a qualified scuba instructor and has over 500 dives under his belt, something I've always wanted to do, but never actually got around to doing, but would love to do it. Just before I actually just put their slides out, I must say one thing about Octane. They're another lender that traded throughout lockdown and actually came out with the products that you have in front of you and that Ollie's going to be going through. He's off. Come back, Ollie. They launched a set of products during lockdown, which one of our delegates was able to give 2 cases to us, both of which have now been offered. One is completing, I believe, either tomorrow or Monday, and the other one we're expecting in the next probably 2 weeks. Yeah. Introducers commission on those 2 cases, £23,000. So very much well worth listening to this guy because they could make a big difference to your business moving forward. So I will just put on Ollie's presentation, which is coming up now. And Ollie, over to you.
Thank you very much, Tony. And hello to everyone. Thank you for joining. Thank you for having me. Yeah, as Tony said, I'm from Octane Capital. I head up the sales, technology, and marketing teams. And again, as Tony said, we like all of you, lockdown's been tough for us, but in a business sense, it's been quite positive. We fortunately didn't have to have anyone furloughed, anyone laid off. We know that being a younger lender, we were lucky in that sense. Also that we don't really do a huge amount of commercial property helped. But yeah, like Tony said, we've launched a new product. We've been hiring staff. We've hired 6 people over the lockdown, and in October we move into new offices in Angel. But I know I've only got 25 minutes. I also know that you've had a long session today, so I'm going to get straight onto the products and what we're talking about. The awkward thing is, and this is a bit awkward for me, is that yesterday we had a bit of an overhaul of these products to make them all even more appealing to your borrowers and to you guys. So as we go through this, I'm going to have to confess to you that one, the sheet you've got in front of you is out of date. It's going to be updated actually on Monday with some lower rates, some better terms, and I will point towards those changes as we go through. But we'll crack straight on. So Octane Capital launched in May 2017, founded by the same people that ran Octopus Property since its inception. When they sold out, they started Octane Capital with funding from Pamplona Capital Management. The team have completed over 3 billion of loans, some of which were pretty complex, some of which you have read about. And we have actually lent over 750 million since launch. Also got to update this last point, which is that as well as Lender of the Year at both Bridging and Commercial and Moneyfacts Awards 2019, we won them both this year as well, which was really, really great news, something we were really excited about. But I know there's only so much any of you care about our awards. But the areas that we lend in, we cover bridging, developer exit, refurbishments and buy-to-let. And generally our ethos as a business, is that we look at every deal on its own merits. And until we launched this set of buy-to-let products, we didn't really have a product. We looked at every deal on its own merits in isolation. We looked at the credit, the portfolio, and what it meant was that we didn't really have a rate card per se. And what I'm getting to is that if you do have anything outside of the buy-to-let space, pick up the phone to us. We've got a 2-hour turnaround time of credit-backed terms. But that's not what today's about. Today's about buy-to-let. And I guess the first question is, why would you go to a bridging lender for a buy-to-let product? I mean, I was listening to a couple of the presentations here from lenders that I know and definitely respect, Lendinvest and MT. And I know that, there are other people out there that offer better rates, but quite often, due to their structures, whether it be that they're a regulated entity or whatever it might be, they can't necessarily offer those rates to all of your customers. And where Octane comes in is really in that area. So there are 2 things, and I'm kind of giving away all the fun here, because this is the big news of our product, which is that there is no stress testing on our buy-to-lets. There is no ICR requirement. It's only 100% of pay rate. And on some of our products, we can even retain any shortfall in interest serviceability. So it's actually sometimes less than 100% of pay rate. But the bottom line is, I'm sure you can already think of clients who are struggling to get the leverage they need, not because the lender doesn't want to offer 70, 75%, whatever it might be, but really because the ICR test they don't qualify for, the yield is potentially quite low, and that's where we can come in. The other area, and this is a bit of a broader thing, is difficult borrowing property scenarios. So adverse credit, unusual properties, things that might typically fall outside the appetite of the mainstream lenders. Excuse me. So headlines are, we lend throughout mainland England and Wales. I will be upfront with you that we might be more restricted on LTVs in more rural parts of the country. But our loans are from 150,000 to 5 million. Rates start at 4.99% with 1% deferred, giving a pay rate of 399. So at our lowest rate, the serviceability is 100% of that 399. We do 5, 3 or 2 year terms. I often ask what happened to 4, but it's just not a popular number, it seems, in our part of the world. And across all the products, there are no ERCs in the final 3 months of the term. 2% proc fee for everyone in Specialist Hub. I would just say that we don't do that for everyone. by way of saying, please don't tell everyone. And again, difficult borrower scenarios, difficult property scenarios, that's really where we live, and hopefully where we can help you and your borrowers. So this chart is firstly overly complicated for a video seminar, but more importantly now out of date. You will see that we have had two different rates for over 500,000 and below 500,000. The good news is that as of yesterday, it's only the top rates. So doesn't matter what size the loan is. On wave 1, it's a 399 pay rate, working that second line all the way up to wave 5. Across the board, it's 100% pay rate, 100% stress test. But the term is something to note. On the first 3 products, it's a set 5 years. On the last 2, it's a choice of 2 or 3 years. And the last line, the ERCs, obviously very important. Again, it's 3% free. It's free in the last 3 months of the term, 0% ERC. But as you can see on wave 4 and 5, it's a 3%. So that's for the 2 or 3 years until the last 3 months. But on wave 1, 2, and 3, before it was, as you can see, 4 in the first year, 3, 3, 2, 1 in each year subsequently. We've actually just decided to completely drop the last 2 years of the ERCs. So for these 3 products at what I consider to be pretty low rates, especially when you consider the stress test, it's only 4% in the first year and 3% in the second and third years. Come the 4th and 5th years, it's free to get out of, completely ERC free. I hope that makes sense. Right, so what we will talk is just talk about the kind of situations where you might think of us. So where the borrower has a limited deposit, we will now actually go up to 75% on clients that qualify for wave 1, and you can get a sense of where that is on your charts in front of you. The only condition is that they don't defer the interest, so it would be at a rate of 499, not pay rate of 399. Foreign nationals and expats, again, you can see from your chart, we are quite flexible with foreign nationals and expats. And memory serves correctly, you can get wave 3 by just owning 1 other asset. And even for first-time buyers, first-time landlords, they can be eligible for this product, which is unusual for many buy-to-let providers. Adverse credit, on the very bottom of those sheets, you'll see how we rank adverse credit and what we look for. And what I would say is when you're looking at these columns, whatever category is sort of the latest column your client is in, that will be the product that you're in. Again, I mentioned first-time buyers and first-time landlords, offshores, companies and trusts. We aren't sort of a cookie-cutter factory type operation. We've got a team of 25. We look to manually do as much as possible of the underwriting. We look to collate the information as automatically as possible, much in the same way as Lendinvest do, and I'll talk about that in a minute. But in terms of working directly with lawyers, we do it on every case. So when there's an unusual structure, it's pretty much par for the course for us. On the right-hand side, in terms of the property, the things that we'd say you'd look for, there's low-yielding property, semi-commercial. We now go up to 30% commercial as a proportion of the whole asset for waves 2, 3, and 4, which again isn't something necessarily many buy-to-let at this kind of price range will offer. Multi-unit freeholds, small and large HMOs. Resi above commercial we're fine with, and ex-council. And again, like Andy was talking about, we might be a bit strict on a kebab shop. We do still reserve the right to say that certain things we don't like, but as a general rule, this is how we view it. Right, moving on. So a couple of case studies for you. So what we want to show you is the impact that the 100% stress test has on the potential leverage that a customer can get. So this was a deal we did. It's a 3-bedroom house in North London. It was worth £900,000. The rental income was £25,200 per annum. And they were a higher rate taxpayer. Now, this is a bit convoluted. I won't waste your time getting into the detail of it. Basically, if you apply the stress test of 2 major lenders, the rates they were offering are 4.34 and 4.09. You might be able to work out who that is, or at least who it was. If you work backwards from there and work out what the maximum leverage there is based on whether they are a higher or additional rate taxpayer or a higher or basic rate taxpayer, you will see that for lender one charging 4.34% per annum, typically the max you'd be able to get as a higher rate taxpayer would be 42% or 51% as a basic rate taxpayer. Lender 2 at 4.09, it doesn't improve it by much, but it does, 54% or 49%, obviously assuming on the 49% that they're using a 140% stress test. Now, very simply, because we don't stress test at a 3.99% pay rate, 25,000 rental income will give you a net loan of 631,579, or a gross loan, sorry. So 70%. And again, we're not going to say that your borrowers that are vastly experienced, that are lowly leveraged, this is the right product for them. But for those that are looking to raise equity, and certainly for those that are struggling to get the rentals that they were getting maybe a year ago, or potentially getting lower valuations and therefore need that higher yield, that higher LTV, this could be a really, really good solution. Case study 2. So 3-bed flat in SW15 worth £875,000, 29,800 per annum, and it's a foreign national with one other UK buy-to-let. Importantly, what that means is they get onto our cheaper rates, our 5.99% rate with one deferred, giving them a rate of 4.99. And again, if we compare it to the typical rates we'd see from 2 major lenders for that client, you're looking at 4.39% per annum, which equates to an absolute max loan, gross loan of 55%. Lender 2 at 5.29, who in fairness using a 125% stress rate, could still only get to 52% because of their higher rates. Whereas Octane, with all the good ideas, no stress tests get you to nearly £600,000, 68% LTV. So again, very simple explanations and demonstrations of how we think the stress test can enable you to get the required leverage for your clients. Last case study. So 5-bed HMO in Liverpool. I don't know about you guys, but HMO in Liverpool is just something we're seeing so much of at the moment. Worth 250,000 and rental income is £32,500. So clearly a very high yielding property. We always talk about low yielding properties, but actually, interestingly, it's sort of medium yielding properties that we struggle with, even high yielding properties that can be a real benefit. Importantly here, the borrower had some pretty substantial, for us at least, adverse credit, but generally we can work out a way to deal with it. In fairness, he had a pretty good excuse, and that does help. And I'd always say, if we've got a rationale for why there was adverse credit and we can empathize and we can understand it, it really helps us sort of build that in and build them a product that suits them. So what do we do here? So we managed to get 70% LTV, 175,000 on a 2 or 3 year term, 6.99% rate. So this is wave 4 with 2% deferred, giving a pay rate of 4.99% per annum. 3% ERC until the last 3 months. Quite simply, I guess the situation you're looking at here is, and actually, I mentioned earlier that we've changed our products. This would actually now qualify for a 5-year term at a pay rate of, I think, at a rate of 5.99 now. So even better. And again, apologies for these changes, but I'd rather tell you about them and tell you about how we're improving them than not. Last thing I want to talk about, and hopefully, if there's any questions, feel free to ask. Someone's just asked if we do second charges. Unfortunately, we do not, I'm afraid. But I want to talk about our process. So we are particularly keen on making life easy for brokers. So what we have done is we've gone back to the absolute basics of what you need to do when you're applying. And we've completely separated out the processes for the broker and the client. So the broker fills in an application form that only requires information about the loan, things about the property, the things that you guys are, experts in, and there's no signature needed. You then send this one link to the client, and through that, they do their proof of address, they're on FIDO, just like Lendinvest, with the confirmation of your identity, and answer all the declarations and sign online, which means you don't need to print, you don't need to go around, meet the client, you can do it all remotely. And from there, within 24 hours, you'll have an underwriting update from our client, along with quotes for, well, you have quotes within a couple of hours for the valuation of the solicitors if necessary. So this is a big thing that we've changed recently. We actually posted an article on B&C saying that this is actually half the time it takes us to process applications. We would very much like you to try it out. And if you've got any feedback, we'd love to hear it. Lastly, any questions? And that's it from me.
Okay, so Ollie, thank you for that. Absolutely brilliant. Good to know that you've made some positive changes as well. So that's yourself and Lendinvest that we've got to do some work on the marketing side to get out to everybody ready as soon as you launch it. So we've got a couple of questions at the moment from Jatinder. Do Octane offer second charges?
So second charges was a no. Sadly, we don't do second charges on any of our products.
Okay. We do, which I'll come on to later. And second one, do you lend to limited companies?
Absolutely. There's very few structures that we won't entertain or haven't worked with in the past.
Okay. I've got 4 pre-prepared questions. Can you lend on new build apartment blocks?
We absolutely can. Now, a couple of things to note. On the really massive blocks, we will have an exposure limit. So we'll, let's say, go to 5 or 10, whatever it might be, depending on the size and the location. For foreign nationals, which there is a huge sort of oversupply of these sort of city centre apartments, we will typically restrict the LTV. But other than that, the only thing to note is that we remove the new build premium from any valuation. It's a usual thing that a lot of lenders do.
Okay, how poor a credit profile will you accept?
So you can actually see on your sheets in front of you, and this is something that hasn't changed. If you look at the bottom, and it will be the far right column of the bottom, that is the worst we would accept on the buy-to-let product. That's not to say that we couldn't make them eligible for a bridge if they weren't eligible for the buy-to-let, to give them a chance to clean their credit, which we're seeing a lot of at the moment.
And remember, as I mentioned before, because we can obtain Equifax searches and experience searches right at the outset that show all the keys information, or basically the credit history on each item of credit, plus defaults, plus CCJs, plus bankruptcies. It means that we can then come, if there is something that's not expected, we can come back to you and let you know this. So when we present the case to Octane, it's presented in such a way that with the explanations already there. So they're not come back and asking for the things, they've already got them upon submission. So I think that's quite important. I'm just going to do what I did before, Ollie, and just move this forward to this so everyone can see this. We've still got some more questions, but just so they can see that. Could you confirm your criteria on semi-commercial property?
Well, so obviously there's a huge range of commercial assets that it could be. I generally say we like things that are leased to with strong covenants. We don't like, random takeaway shops, and there's a huge range between that. The thing for us is that we don't like looking at any one element of the deal and ruling on that basis. Obviously, we have to on the buy-to-let, but there's a big difference between a borrower who's got a portfolio of 50 semi-commercial properties, all of which are takeaways, versus Bob off the street who's doing his first one. So what I can promise you is there's nothing we won't take a look at all, and we will very much look at the other aspects of the deal before weighing in on that particular element. I hope that makes sense.
Okay, last question I've got is, and there's no more being asked than that, so will you consider a higher percentage of the commercial element above the current 25%?
So we have just moved that to 30%. So a little bit is all I've got for you. But obviously, again, on our bridging products, we can offer a higher proportion. On the buy-to-let, it's a max of 30.
Okay, so everyone, as you can see from the final slide, if there's any documentation needs you have, everything is now, I'm actually looking at our website at the moment, there is an absolute stack of Octane documents on there. They're all dated, so you can see they are the up-to-date ones. So we've got your application forms for company and individuals, standard requirements checklist, direct debit mandates, property schedule forms, literally everything you need. Plus also obviously the decision in principle forms. So everything is there that you need. So just again, either write down what you can see, the lenders.specialisthub.co.uk/Octane, or just look at your buy-to-let product guide, and it is mentioned about 4 or 5 different times within that. Pretty much, Ollie, that was absolutely fabulous. Thank you very much indeed. We are way ahead of time, actually. This is good. This is excellent. So early lunch for everybody. So Ollie, thank you.